hope you enjoyed your dinner, and it is now my pleasure to introduce our very special speaker for today, John Williams, President and Chief Executive Officer of the Federal Reserve Bank of New York. President Williams serves as the Vice Chair and permanent voting member of the Federal Open Market Committee. President Williams joined New York Fed in 2018. Prior to that, he was the President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. Before assuming that role, he was the Executive Vice President and Director of Research at the San Francisco Fed, which he joined in 2002. Mr. Williams began his career in 1994 as an economist at the Board of Governors of the Federal Reserve System. In addition, he served as a senior economist in the White House Council of Economic Advisors and as a lecturer at Stanford University Graduate School of Business. Mr. Williams holds a PhD in economics from Stanford University, master's degree from London School of Economics, and undergraduate degree from University of California at Berkeley. We had the pleasure of hosting President Williams in 2015 in his capacity as President of San Francisco Fed, and today the New York Association for Business Economics is deeply honored to welcome him back, now as President of the Federal Reserve Bank of New York. President Williams, the podium is yours.
Well, thank you for that introduction. It's great to be back here. I didn't realize it was 10 years ago that I met with this group before. So I'm pleased to see my fellow economists and colleagues enjoying a long summer evening in the city in the best way possible. And that's indoors and prepared for a robust discussion on the economic outlook. For anyone who spent any time outdoors today, I think you agree with me on that. I've been looking forward to this conversation for some time. And before we turn to the discussion and the Q&A, I'd like to take just a few minutes at the start of the program to share my assessment of recent economic data and how it's informing my outlook for the economy. Particularly, I'll explain what the data are telling us in light of recent economic uncertainty and how I expect the effect of tariffs to take shape. Now is when I must give the standard Fed disclaimer that the views I express today do not necessarily reflect those of the Federal Open Market Committee or others in the Federal Reserve System. So you all read the news and you're all familiar with the facts and figures. The changing landscape around trade policy has heightened economic uncertainty among households, businesses, and financial market participants. The response to these developments and the associated uncertainty has led to interesting and sometimes contrasting dynamics in both the soft data and the hard data. Now, soft data, such as the regional business surveys conducted by the New York Fed, have highlighted an elevated degree of uncertainty about the economic outlook over the past few months. All told, concerns about tariffs are widespread, resulting in a reported pullback on capital spending. Similarly, our national survey of consumer expectations shows that consumers' uncertainty along a number of dimensions remains elevated as well, leading many households to scale back their expected spending growth on non-essential items. In addition, survey respondents report that their uncertainty about future inflation remains elevated. But some soft data have also provided more encouraging news. For example, in the SCE, longer run inflation expectations have remained stable, while short and medium term inflation expectations have returned to their pre-pandemic ranges. And this is critically important because well-anchored inflation expectations are essential for sustained price stability. So now I'll turn to some hard data. And by these measures, the US economy remains in a good place. Real GDP growth has been unusually noisy, largely reflecting the effects from the front running of tariffs earlier this year. That said, the data are suggesting that economic growth has slowed relative to last year's pace. Now, all of this data, both hard and soft, feed into my assessment of how the economy is faring with regard to the Fed's dual mandate goals of maximum employment and price stability. On the employment front, the most recent data show a solid labor market, and it's demonstrated by measures of unemployment, employment, vacancies, hiring, and quits. Job growth is slowing, but so is labor supply, owing to lower immigration. Overall, labor supply and demand are well balanced, and there are no signs that the labor market is adding inflationary pressures. With regard to price stability, inflation has continued on a gradual, albeit bumpy, downward path toward our 2% longer run goal. Now, based on my reading of the June CPI and PPI data that we just received, I estimate that the 12-month percent change in the headline PCE inflation in June will be around 2.5%, and the core inflation will come in about 2.75%. Now, I often say that I look at the totality of the data to track underlying trends and evolving conditions. So in addition to closely watching the data and trends I just talked about, I've also been keenly watching the effects of tariffs on the prices of goods and services. Now, one question that comes up a lot these days, and maybe will come up in our discussion later, is all we hear about is tariffs, 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 but then why hasn't inflation gone up? So to answer this question, you need to dig into the details of how tariffs affect prices, and that means getting into the data at a more granular level. So we are seeing initial effects of tariff increases on core goods prices. Specifically, for items that are more exposed to higher tariffs, household appliances, musical instruments, luggage, tableware, price increases so far this year have been well above what one would have expected based on past trends. And using granular import price data and the linkages measured through the input-output tables, we can see if these patterns occur broadly across categories of goods and services. And in fact, we do see a positive relationship between a category's exposure to tariffs and its price increase to date this year relative to the prior trend. Now, it's important to note that it's still early days for the effects of tariffs, which of course take time to come into full force. So combining enacted and announced tariffs, estimates of the resulting average effective tariff rate range somewhere between 15 and 20%. But actual tariffs in effect in recent months were much smaller than that, as seen by the amount of tariff revenue that's been collected each month. For example, net tariff receipts as a share of imports rose from around 2.25% in the first 3 months of the year to around 8% in May. On top of that, it takes time for the tariff increases to pass through to domestic prices. In particular, businesses and consumers bought imported goods in droves in anticipation of the higher tariff rates, and that likely delayed the effects on domestic prices. Nonetheless, businesses are very focused on tariffs, and they say they expect to respond by increasing prices. A special New York Fed survey of businesses indicates that firms passed on at least some of the higher tariffs to their customers, with nearly a third of manufacturers and about 45% of service firms fully passing along all tariff-induced cost increases by raising prices. So all in all, although we're only seeing relatively modest effects of tariffs so far in the hard aggregate data so far, I expect those effects to increase in coming months. Overall, I expect tariffs to boost inflation by about 1 percentage point over the second half of this year and the first part of next year. Now, another element to the inflation outlook is that the lower foreign exchange value of the dollar that we've seen this year likely will add somewhat to inflationary pressure going forward. Importantly, we won't know exactly the magnitude or the timing of how these various factors will play out until we see more data. That's why I'll continue to be vigilant and monitor prices and broad movements over time to best assess evolving conditions. The combination of continued uncertainty, a solid labor market, and inflation still above the 2% goal led the FOMC to decide to leave the target range for the federal funds rate unchanged at 4.25% to 4.5% at its most recent meeting last month. Maintaining this modestly restrictive stance of monetary policy is entirely appropriate to achieve our maximum employment and price stability goals. It allows for time to closely analyze incoming data, assess the evolving outlook, and evaluate the balance of risks to achieving our dual mandate goals. In addition, the FOMC continues to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities, and that process continues to go very smoothly. So I'll conclude my remarks with a question that likely brought you here this evening. What is my outlook for the economy? So given all the uncertainty, a number of outcomes are possible, but based on what the data tell us today, I expect uncertainty and tariffs to restrain spending and reduced immigration to slow labor force growth. As a result, I expect GDP growth this year to be about 1%. With this slowdown in growth, I expect the unemployment rate to rise to around 4.5% by the end of this year, and I expect inflation will come in between 3 and 3.5% in 2025, and then to fall back to about 2.5% next year before reaching 2% in 2027. As the summer progresses and we look toward the remainder of the year and beyond, I'll remain focused on all of the data. The soft data from surveys and the hard data we see in real GDP growth and consumer spending, and tariffs effects on goods and services, and what it ultimately means for the achievement of our dual mandate goals. There's definitely heightened uncertainty about the path of the economy, but it's too early to say what the trajectory of the hard data will be. No matter what the future holds, I'm committed to supporting maximum employment and returning inflation to our 2% longer run goal. So thank you for hosting me this evening, and I very much look forward to the questions ahead of us. Thanks.
So John, thank you for your remarks, and let's dive deeper in some of the topics that you mentioned. So let's start with the inflation. We have been waiting to get back to 2% inflation for a while, and
it's not a good sign that the sirens start right at the beginning of your questions. I hope you didn't plan that. Go ahead.
So we've been waiting to get back down to 2% inflation for a while. What are your thoughts? Why has the progress plateaued, and when do you think we'll get there?
Well, it's a really important question. I talk about the dual mandate goals and maximum employment price stability all the time because they are really important, and that's what we're focused on. And I think there's two ways to look at the progress of inflation. A couple of years ago, maybe I had this speech. I talked about the layers of the inflation onion. So I'm going to bring that back a bit. There were parts of the inflation process of the rise in inflation in 2021, 22 that were really, pretty extreme and rapid, especially in goods, commodities. And then we saw a gradual but very pronounced increase in services, and especially in housing services. So getting to your question, so we saw these different aspects of the inflation process on the way up, and we've seen the different aspects on the way down. So the goods and commodity prices, inflation came down much more quickly. That's kind of was, I think, expected. We saw service price, non-housing service inflation come down more gradually, and the housing prices part of the PCE price index, that's the one that's been, now we start using words to treat it like it's a person. It's been stubborn, it's been difficult or things, but that actually has progressed as well. So I think one of the reasons we've seen the gradual process is really the fact that housing inflation in the price index, housing inflation has come down gradually, but that process has continued. I think all the forward-looking indicators support that. And then we've seen it in the non-housing services happen gradually. And I think, honestly, if we abstract right now from tariff effects, we would see broadly inflation moving closer to our 2% goal. Now, we have a new kind of component of that, and that is what's the effects of tariffs. I just talked about that. But I guess my view is, if I can set the tariffs effect side on goods, it did take a while for that slowdown in housing inflation to translate into the inflation measures we use. I think we understand that better now. And we've seen, it took a while for the supply and demand imbalances that occurred post-pandemic and post Russia's invasion of Ukraine to finally work themselves out. I do think over the past 2 years, what's been remarkable is the disinflation process has continued. Again, a little bit of a bumpy trip, but it has continued. And it's happened in the context of a labor market that has throughout that period been solid, with unemployment in 4 to 4.25% range. So, I mean, I guess that's kind of my view of how it has taken a bit of time to occur, but at the same time, I think the good news there is it's happened in the context of a pretty solid labor market.
So turning back to the effect of tariffs on inflation. So yesterday, as you mentioned, we had a CPI print that seemed to finally indicate some impact of tariffs. And yet today we have the PPI that was more benign. And it reminded me a game that I played when I was a kid, which is now you see me, now you don't. So you probably know this game. It's probably universal. Was the CPI report a surprise to you? And going forward, what are your thoughts? Is the tariff persistent and significant effect on inflation, or is it more, let's say, fleeting? Because I want to avoid the T word.
Thank you. Yeah, the T word has had its come back into the conversation, transitory. I think one thing I highlighted in my speech, and I kind of got into like very nerdy data stuff there about tariff revenues as a share and things, was to point out that basically we really started seeing the effects of tariffs on businesses, on importers, on American companies, not in March or April, but it started really picking up more in May, and I think the most recent preliminary indicators was more pronounced in June. So it isn't really a surprise that you saw pretty small tariff effects back in March and April, and you're seeing bigger ones maybe in increasing effects in May and June. And again, there's a lot of uncertainty about what tariffs will be in place in the future. So I just take that as a given that there's uncertainty. But I would expect to see the effects of the tariff. I'm not as surprised by the fact that they've been relatively small in the past, because I think the actual tariffs that have been hitting the businesses have also been smaller. So I do expect them to grow more. On this, looking at the data, the month-to-month data, I think one thing that, there are cross currents here. There's some pretty good news on service price inflation. We've seen, like I said, the housing inflation, other things, bringing core service price inflation down, and I think that's something we wanted to see. So when people say, hey, inflation seems to be kind of flat or not moving around a lot, I think it does reflect two different factors. One is the underlying disinflationary process, which I think is still underway, and some modest pickup from the tariffs. The other thing I just think we always have to tell ourselves is, I'm going to kind of broaden this out. I feel it's very important to be data dependent, to analyze the data, to take the totality of the data, but we can't be data point dependent. We can't get too caught up in one release or another. My view on CPI and PPI was that overall it's basically close to kind of what I think a lot of people expected. I think it wasn't a big combined. It didn't really change kind of my view of what was going on. But I do agree with your point. Is we are seeing with June data a little bit more of the effects of tariffs, at least on goods prices.
Thank you. And let's turn to labor market. And as you mentioned, the labor market has been remarkably resilient. Yet we are seeing some signs that there's slower hiring and also layoffs. Lower layoffs. And we also have the shrinking labor supply, partly due to the recent immigration policies. Both the FOMC minutes and the Beige Book reflect these concerns. And while the churn rate is not part of your mandate, I wanted to hear how much should we worry about this lack of dynamism? And do you think it's perhaps a sign for potential troubles ahead?
Yeah. I think you've raised, a bunch of the very important questions that we've been trying to understand the labor market, especially over the past year, I'd say. And there's absolutely no question about this one observation, that we are seeing a low turnover labor market, low hiring rates, low quit rates, vacancies are basically, vacancy to unemployment pretty much back to normal levels. But we're seeing an economy that there's not a lot of churn going on. So I think one good explanation for that, and one that I think fits well with what I hear from business leaders that I talk to, is really that this is an artifact to a great extent of the uncertainty that businesses face. And businesses say, hey, I got burned on laying off workers before. I want to, so a job match is like a capital investment. It's an asset that you hold. So if you let somebody go, even if maybe business is slowing, then you have to rehire them. You lose the value of that match. Similarly, hiring somebody is taking on the cost of bringing someone on and onboarding them and dealing with that. So I think businesses have basically been trying to minimize making those investments, whether in the labor market and in some cases in other investments. So I think that's why we're seeing this kind of very cautious Don't lay off people because we want to find out what's going to happen with tariffs and other uncertainties. At the same time, let's be very careful about hiring because we don't want to hire people if we end up that's too much. So I think that's part of this discussion that you definitely hear with business leaders. In terms of the lower kind of employment job numbers in the establishment survey, I do think a big part of this is immigration, as you suggested, as I mentioned in my speech. I go back to the last couple of years, and I think the thing that caught everybody off guard was we were getting all this job growth, good GDP growth, GDP growth like 2.5% or something like that. We were getting all this job growth, unemployment was flat, and I'm an old school macroeconomist, Okun's law, all these relationships are kind of right in my thinking, and you realize something's happening behind the scenes. Something is shifting behind this, and obviously we were watching this as close as we could. It was the immigration and the huge increase in labor force was affecting the ability of how many jobs can you create, without making unemployment go lower. I think that's completely reversed. So, what's a normal replacement or normal job growth number for a stable labor market has come down a lot. I know that you all think about these issues. I think the hard thing here, just as it was the last 2 years, is we don't have as good real-time data on what's happening in terms of the labor force with immigration and things. We know that the labor force's growth has slowed. Having a good idea of exactly what that means is I think, harder. For me, I always say look at all the data, but that uncertainty about kind of the supply side of the labor market tells me to focus a little bit more on the levels variables, the unemployment rate, the vacancy rate, the hires to quit, so all the things I just mentioned. The levels things are probably less affected by the flows, because the flows I think are affected by these supply side factors. Now of course you always look at the employment numbers because they are a great telling indicator of the direction of the economy. So I'm not suggesting not to look at them. I just think it's harder to say, is that a good number or a weaker number? I mean the numbers have been fine. I'm just saying that I've tended to look at the levels a little bit more because of these changes in the supply side of the labor market.
So can you comment, and you brought up the transmission, so transmission of the monetary policy, and how has it evolved over the recent years in light of some of the developments that you mentioned? So for me, there are three broader developments. One is the homeowners are locked in low mortgage rates. The second is we have experience with inflation, which is recent and salient. And the third is we have experience with labor shortages, which are also recent and salient. How does this affect the effectiveness of your standard tools or the reaction function, or perhaps the parameters of your reaction function?
How many hours did we agree to talk? Because that is a huge set of questions and hard questions. Ones we ask our economists to think about all these issues. So let me take the easy one first, and that is the mortgage kind of rate lock-in. I'm not going to say anything deep here. I mean, it's pretty obvious for anyone who's got a 2%, 3% mortgage that creates a big incentive. There's option value with your fixed rate mortgage not to move, not to sell, and that creates some lock-in effects in that market. So I think that's true. How does that affect the transmission of monetary policy? I think it probably does diminish on that one dimension, or reduce the effect of monetary policy that would have on housing activity, people buying and selling houses, maybe building houses and things like that. So I think in the short run that probably reduces the effect of that particular channel. I will say that all the analysis I've seen or done, I mean, housing is an important one for us. There's a lot of other channels of monetary policy as well, so it's just part of that. I mean, you can see this difference when you talk to your peers and colleagues around the world who have primarily adjustable rate mortgages, because I'll tell you, short rates go into adjustable rate mortgages very powerfully and forcefully, and I think that dynamic is kind of the normal one. In terms of inflation expectations, this is something I watch, my colleagues, we all watch very carefully, and it's something that is absolutely so critical to successful monetary policy. Without anchored inflation expectations, you get these famous or infamous wage price spirals, you get all of this inflation persistence and all that. And we saw that in, many of us saw it in our lifetimes, we've studied it. So to me, a critical part of making monetary policy was to not assume that inflation expectations were well anchored, but to take policy actions and our communications to reinforce the anchoring of that. I think that was successful when we tightened monetary policy, when the communications that the chair made, famously as Jackson Hole speech then, and the actions that we and other central banks took. I think really quickly we saw a pretty clear signs that inflation expectations were, the long-run inflation expectations were well behaved. But like in the New York Fed's 3-year ahead inflation expectations had started moving up. But as we tightened monetary policy, as inflation started coming down, we saw those inflation expectations coming down. And as I said, they came back down to pre-pandemic kind of averages or ranges. And that's where they are today. So I think that was just a very important dynamic. So there is this question about, well, wait a minute. A lot of people had never seen inflation before, but now they have. Are they sensitized to it? And we've analyzed that using the survey of consumer expectations. It's a panel. We have 1,300 households. They're in the panel for 12 months. So you can do a lot of econometrics with this. And so one of the things that we're seeing is, in my view, and I've talked about this publicly in some speeches, is that the behavior of inflation expectations overall in the US population, a kind of response to inflation surprises or things like that, actually has been about the same or maybe even a little bit better during the last 5 years than it was before. So I don't see signs that people kind of sensitivity to inflation has changed in the SCE. That's my reading of that. We do see a change by age. Okay, so my kids are in their late 20s, early 30s. So when as a Fed policymaker, all my career, Fed economist, monetary policy person, I've always said, it's really important that we not allow inflation, to happen. We need to have price stability. And my kids said, what are you talking about? I've never seen this thing. What do you know? Like you're making me watch some, ancient black and white movie or something. And you saw that in the SCE. In the survey of consumer expectations in 2019, the under 40 crowd, which I call the very young, they had very low inflation expectations on average. And the over 60 crowd, which I call prime age, they had higher inflation expectations. We'll look at the SCE page today, NewYorkFed.org, SCE. You'll see that those groups have actually moved together. So I think what we're seeing is the people, like my generation older, who experienced the 70s and 80s, maybe in their youth, but maybe in their adult lives, they actually, I think, have been reassured that inflation didn't stay high, that we didn't have the 70s, 80s experience. And for the young people, they suddenly go, okay, now we know what inflation is. But their inflation expectations, like the older, they're all about the same, about where they were on average before. You had a third one about,
there was a labor market. I think you might have answered that. The experience of the labor shortages.
Yeah, so that's a good question. I mean, this is a hard one. So the question there's some very, very general language that's been used about the Phillips curve. So I'll just use the Phillips curve as the descriptor. There was a flat Phillips curve before the pandemic, and then there was a nonlinear Phillips curve during the pandemic. And now what are we? Is it steep? Is it flat? Is it nonlinear? I honestly think we don't know the answer to that question. So I don't think it was probably as flat a Phillips curve as some people kind of observed in reduced form regressions. And at times, I know I and some other people argued that you didn't see that flat Phillips curve in wage data or some other things. And I think that the nonlinear one is so hard because a lot of the analysis of the pandemic inflation in the US and the Euro area and around the world there were significant supply shocks. And supply shocks are happening and they're correlated with demand shocks. It's just the identification issue. I am speaking to economists, so I can talk like this. The identification issues are very tricky, and I think that's still an open question whether the high inflation we saw was just a mixture of big supply and demand shocks. in the paper a couple years ago, Bernanke and Blanchard, looked at this in their own model. Other economists have looked at it for other places. So I think it's a bit of an open question. So, I go back to, like, how do you have a robust strategy for monetary policy? I guess robustness means you don't assume the Phillips curve is flat, you don't assume it's steep, you don't assume anything. You think about a strategy or approach that will work well regardless of what situation you face. So I'm sounding like I'm very uncertain about exactly what the right answer is. I think the thing that I'm certain about is don't assume a flat Phillips curve, don't assume something. When I go back to when I studied economics as a student back in the 80s, and I studied monetary policy under John Taylor when I was doing my PhD. I mean, you think about it, monetary policy essentially back then was about supply shocks. Right? Demand shocks are relatively easy. You offset demand shocks. It's the supply shocks that create the difficult trade-offs. That's what monetary policy rules was about. That's what monetary policy inflation targeting was about. So I think a lot of how I think about what the lessons of the last 5 years are really just the things we learned. I learned 35 years ago. It's just that the supply shocks didn't ever go away. We had a period where demand shocks were much more important, because of the lower bound, because of the low inflation. But the supply shocks were always there, and I think that is an important kind of reminder.
So I want to hold the thought of expectations and uncertainty, but first I want to touch on the housing market. So the 70% of mortgage holders are locked in under 5% and 40% are locked in under 3.5. But the 30-year fixed is now under 7%. So low supply and sluggish home sales and affordability have been with us for a while, but recently there are some additional signs of weakness. Do you think the housing is a headwind to the economy? And do you worry about the mortgage rates? And if you do, how do you think about the 10-year rates in relationship to the rates that you do control?
Well, I try to avoid opining on the level of asset prices in the economy or rates in the economy, because obviously those are determined by a multitude of supply and demand factors and risks and things like that. I don't think that overall, if you look at what's happened, with 10-year Treasury yields this year, they have fluctuated a lot in high frequency, but have been in this range. That pretty consistently in a kind of a range. I think that to me the housing issue or housing kind of affordability issue and is far more than just what the mortgage rate is. I think that the mortgage rates today are not that different than mortgage rates that we saw in years past. I mean, higher definitely than the past decade for sure. But I think there's other factors that are affecting that. We have the lock-in effects, which you mentioned. I think we have a lot of uncertainty in the economy. And I think there's still a lot of just very high cost of construction of housing. I travel throughout the second district for the New York Fed is New York, northern New Jersey, western Connecticut, and Puerto Rico and USVI, and I visit all of the islands of the second district, including the one we're on right now. But I think that there's issues about the affordability in terms of construction costs, availability of labor, the trades, and also issues about zoning and things like that. So I think it's a richer set of issues that affects the cost of new housing and housing. Mortgage rates are definitely part of that, but I don't think that the whole story.
So let's turn to expectations. And how do you weigh survey expectations versus hard data in your decisions? And also on a similar note, how do you weigh the survey expectations versus expectations embedded in market instruments like tips and...
So, I mean, I use the phrase, I look at the totality of the data because I think you get information from everything. I think financial markets, so this gets to, market-based, break-even inflations or swap rates and things like that for inflation swaps. I think that's informative. It's telling you where it's telling you the mean expectation. There's a risk kind of pricing embedded in that, but it's giving, I think, informative information from the market. So I think that expectations from the markets, market-based measures is relevant. I actually think the surveys of households and businesses, and we do this survey of households, and LandFed does some great surveys of businesses, so do others. I think those are informative too. I know some people are kind of critical of surveys of households and businesses, because what do people really know and what are they answering and things like that. Especially since I've been in the New York Fed and with our SCE and studying all this over the last few years, several years, it is striking how I think thoughtful and informative these surveys are. Because in the New York Fed, like the Atlanta Fed survey, we ask people for distribution. We ask them for density forecasts. So basically, is inflation between 0 and 2, 2 and 4, 4 and 6, and what percentage you put in that. And the measures of the mean, the measures of the second moments, standard deviations, skews, and things like that, actually move around in a way that I think is very informative. So I add that to this. I think the one thing we always have to be careful or just be cognizant of is every data source that we look at has some limitations. And okay, so I'm going to sound like I'm in a marketing mode, but I think the New York Fed survey is a really good survey of households, and I'm not dismissing any of the other surveys of households that are out there, inflation expectations, but I think some of them have some challenges, a little different methodologies, and I think you learn something from about all the different ones. And then on hard data versus soft data, I think, at the end of the day, soft data surveys can give you a sense of things, but they can also have the false positives issue. We know that confidence surveys can sometimes be misleading, and so the one thing I've learned in my 3 decades of doing this is don't count out the American consumer. They tend to hold up very well. So I think you have to look at the soft data and you have to talk to people. I think that's an important source of soft data. But you got to, in the end of the day, also got to see what's happening. What's happening to retail sales? What are businesses actually doing? Not just what they're saying in a survey.
So what are your thoughts of the recent divergence between hard and soft data? Do you think the way we measure expectations have to evolve? And I should say that I'm a big fan of the research that your research department produces. Gizem Kosar and Georgia Topa have a series of very interesting papers on how to measure expectations. But recently we've seen divergence in some data sources. What are your thoughts about that?
Yeah, I think this gets to the issue. I think sometimes it's just the issue of what question people are answering. I think that in the surveys, like in the SCE, we try to be very specific. What do you think? We don't say CPI or PCE inflation, but we say what percent change in prices do you expect over the next 12 months? So try to be very clear on that. Because I think people may be answering whatever question is important to them. That's actually a good thing, right? It's good to hear what people think it's important, but at the same time, sometimes it's hard to discern, kind of exactly what they're thinking about. And we know that there can be, issues of salience and things like that in surveys. That certain things, affect people's kind of view on prices, certain goods or services more than others. So I guess I just feel like the lesson of the past decade or more is that we have so much more data than we used to. So for those who don't know, I'm a time series macro person. That is literally the dinosaur of economists. Because to me, 160 data points is nirvana. And today, you're talking about 160,000, 160 million or whatever, and the ability to use panel, cross-section, and do stuff. And analyze things. So I feel like, to me, I look at, when you look at all the data sources we have from data providers, and I'm not advocating for one or the other, but you think about Indeed, you think about, all Zillow, everything, like in, my screen and my, briefing books are just, and all of my colleagues are filled with all these data. And I think one thing that's really interesting to answer your question, because we could talk all day about this, but is some of these data are inherently forward-looking, but they actually are data. So the one that's gotten a lot of attention the last couple of years because of the stubbornness of housing prices are these measures of the rents embedded in newly signed leases. So to me, this is like this beautiful thing because the rent data in the CPI or the PCE is what the rents people are paying. I might have signed a lease 2 years ago, so that's a price that was set 2 years ago. But the data we get from some of these providers is you signed a lease in July, this is the rent you're gonna pay for the next year. So it gives you a very good read going forward. Now it's noisy, it's not representative. all those issues. But to me, it's a really good forward-looking indicator. Similarly, with the wage data, we have the great work of our colleagues in Atlanta and other feds about looking at, kind of job changers, switchers. If you stay in your job like I do, you get your pay increase every year. But if you go and switch a job, suddenly you're marking to market. And so that gives you a really interesting read. What percentage of people are switching jobs? What are the wage changes again? So I think there's a lot of, I don't know if it's soft data or hard data, but there are data like this that bridge between kind of a current hard data like the establishment survey versus something that's telling you where things are likely to go.
So before we turn to the audience, you are a Star Trek fan and also an economist. So
isn't that the same thing? Okay, between the Lord of the Rings, Star Trek, and Star Wars, and maybe, I don't know, Marvel kind of world, or, I think that covers most everybody.
So the reason I brought it up is I really want to hear your thoughts on AI, and I thought it has a futuristic and sci-fi aspect of it. So where do you stand on AI productivity debate?
Okay, so so we're economists here. We were given two hands for a reason, so I'm going to be the two-handed economist on this. So I think AI is real. I talk to CEOs, I talk to, leading academics. Everybody thinks this is a real thing. That doesn't mean, and they think it's a general purpose technology. So for those who know, this field, a general purpose technology is a technology that can be applied to a wide range of activities, either in terms of industries or in terms of creating new goods and services. You go back to the history of science, you can think of computers, you can think of electricity or electrification, actually. You can think about these things. So I think there's a consensus. It's a big deal. Obviously, lots of money going into it, and it has the qualities of general purpose technology. So I'm going to just stipulate that I accept that, because I'm about to get the other hand going. So I think that the question that we all have to ask ourselves about AI is not so much is it important or real, are businesses investing in it, or are they going to affect productivity? Because we have machine learning, we have automation, we have robots, all that's happening. Many of you do this, but if you go to a modern factory that was built in the last 10 years, it is in the US, it is automated, it has robots, it has incredible technology and probably AI embedded in there. This is already a thing. So the question is, where does it go from here? So now I'm going to do what I consider my kind of lessons we learned from Bob Gordon, one of the great economic productivity historians. And the question that I think we really have about AI in the future is it, so let's just imagine we're having this conversation 10, 15 years, 20 years from now. So is AI the thing that produced or helped contribute to the 1 to 1.5% productivity growth that the US economy has delivered for over a century? Because the greatest miracle of the US economy is it generates unbelievably good productivity growth over long periods of time. And if you compare our productivity to Europe, to a lot of places around the world, we are the envy of the world because of the miracle of compounding, of producing 1 to 1.5% productivity growth year after year. So the question is AI the thing that got us that additional 1 to 1.5% productivity growth? If it hadn't been for AI, we would have stagnated. So why do I even ask that question? Because a lot of researchers who study science and technology and productivity, like my friend Chad Jones at Stanford, he argues that diminishing returns to innovation, lower population growth, a lot of different factors tell us that without some major change in this process, productivity growth is going to get slower and slower and slower. Just a lot of diminishing returns kind of kicking in on R&D and new ideas. It takes far more R&D people, hours, billions of dollars to generate a little increment of productivity than it used to. That's the basic premise. So one version is AI the thing that's going to be like computers and automation and electrification and all these things that deliver this magic of continuous growth? Or is it going to be the thing that goes way beyond that? And some of the companies or institutions represented here, I know, have taken positions or taken views that yes, it will be this kind of extra kick. I would just warn against the danger of addition here. I think someone has written about this. You can't just say, oh, we get 1.5% productivity growth, and then AI gives us extra 2 percentage points. You can conclude that. I'm not saying that's wrong. I'm just saying that addition is, I think, maybe the mistake. Because I think AI is probably going to be like computers and these other things. It's the thing that's going to give us the 1.5. And then the question to me is, what gets us more than that? So in my life, you know, you go back to the productivity slowdown of the early 70s. We have, since the early 70s in the US, we have only had one period of sustained above average productivity growth since 73. And that was 96 to 2005. That's it. We've not had any higher productivity growth. I know it's a shock to you, but social media did not create a productivity acceleration. Google did not. All the other things that we have that are great did not, because they were the things that kind of generated that steady productivity growth. So I guess my answer to your question is, I think AI is real. I think it is a GPT in ways. The question is are we going to look back and say, you know, thank God we had the ability to continue to automate and use machine learning and summarize memos and apparently write our emails for us, because that gave us our growth. Or are we going to get this, you know, 3% growth or something? I think the honest answer is, I don't know. I will say the US is the leader in this, on developing it, building it, and using it. So it is an amazing productivity advantage for the US. You know, obviously China too, but for the US relative to a lot of other countries, I think it's going to be a big driver of our economy, because I think it is going to be a huge amount of investment, a huge amount of use. All right.
So thank you, John. And with that, let's open to the audience.
Very much.
Yeah, it's working.
Thank you very much, Mr. Williams. Alexis Crow, Chief Economist at PwC, and I'm a Senior Fellow at Columbia Business School. I've followed your work on R-Star over the years and deeply appreciated it, and wonder where you stand, it's probably a two-handed answer, on where R-Star is on the longer run.
Yeah, this is where you get a clear one-handed answer. So R-Star is the natural rate of interest, neutral interest rate. It's basically the real short-term interest rate that we expect to prevail over the medium or longer term. The way me and Thomas Laubach described it 25 years ago is that it's the real interest rate that it obtains when the economy is growing at a trend, your full employment inflation is low and stable. So that's the idea of what it is. We've been estimating this now for, well, 25 years. And you know, it's an interesting point to make on this, is we started this project back then because of the high productivity growth question and how much did that raise the neutral interest rate. Larry Meyer, governor back then, you know, a great business economist through his career, asked us the question when he was a governor and as a staffer, and Thomas was a staffer, asked us, you know, the Taylor rule is great, but what do you put in for the intercept of the Taylor rule? Is it 2%, which is what John assumed, or is it something else? And does it change? And that led to this view that with a period of high productivity growth, high growth, you would expect the neutral rate to be higher, and that's what we found. Then after the financial crisis recession, we saw those estimates fall from about 2.25 down to around 0.5%. They've been relatively flat since then. They rose a bit during the COVID era. Today, our estimate from my preferred model, which is with Catherine Holston and Thomas Laubach and myself, is for the U.S. is around 0.75%. So I think that's a reasonable estimate. I think some estimates, you know, you can get somewhere between 0.5% and 1.5% for a real interest rate from different estimates, depending on what you look at. I will notice that the estimates for Europe, and the ECB publishes a range of those, but we estimate that for Europe is closer to 0 for a real interest rate. And I think that's not that controversial. So it's interesting. There is a big debate in the U.S. has the neutral rate gone up because of fiscal policy, because of deglobalization, some other factors. I think the evidence in Europe is a relatively modest increase, maybe there's something like 25 basis points. For the U.S., I would say the evidence is still relatively modest, somewhat higher. That's based on actual data. So if you ask me, wait a minute, you get this AI boom, huge productivity investment boom, would that push up the neutral rate? Absolutely, but it's not in the data. Fiscal policy, is it put, you know, higher debt to GDP, does that push up R-star? I would say yes, but so far the effects seem to be relatively modest. So my answer is, you know, it's uncertain. It's hard to measure, but I would argue that the estimates for the U.S. and the euro area seem to be around or just modestly above the estimates that we had before the pandemic. Very different than what you get from market measures. If you take a clean read of TIPS yields or something like that, those are higher, but it's always, with yields, it's always a question of there's a risk premium, there's a liquidity premium, other factors. But anyway, that's kind of my take on that. Yep.
Hi, my name is Sonia Meskin. Thank you so much for being here. I'm a senior economist with UBS. And my question to you is, as the president of the New York Fed now, the New York Fed works at the intersection of economics and financial markets. What are your thoughts presently on the divergence that we seem to be seeing in most economists and Fed's estimates of what is going to transpire through the rest of the year in 2026 growth-wise, and what we're seeing in the financial market measures, especially equities, and do you feel that potentially liquidity, global liquidity, has a role to play in that?
Yeah, I mean, that's a topic that's getting a lot of attention these days. Of course, some journalists have picked up on this, and other commentators have picked up on that. So the equity markets are, very strong, absolutely. Bond yields, like I said, have been moving up and down, but haven't moved that much one way or the other. And then you look at, risk, credit spreads, other measures of kind of the economy are very bullish. And a lot of forecasters, see economic growth slowing. It's always hard. I don't like to predict what's the probability of recession. I personally don't spend time on that. But clearly in the private sector, we're seeing kind of probability of recessions haven't come down since, say, early April. So I feel like the macro forecasters are looking at the data. I'm looking at the data. We're all looking at a lot of the same data, and seeing reasons why growth this year will be somewhat slower than last year. I don't think it's I see positive growth. I think the markets, obviously, they have other factors that drive, like equity valuations. Clearly, the fiscal policy, tax policy, some views on where regulation will be going, I think affects people's views on valuation. And similarly, we have, one of the things about the U.S. economy is like I said earlier, we are the leaders in the technologies of the future. We've been the leaders of the technology of my life, but into the future. And so, of course, you have the Magnificent Seven and a lot of that. So a lot of the equity market is also driven by, I think, positive views of profitability of U.S. businesses. So which is right and which is wrong? I mean, it's always hard to say. There's a joke, of course, that equity markets predict recessions too often. So I do think that, my view is financial conditions overall are pretty supportive of growth, looking at asset valuations and things, and credit spreads and all of that. I do think there are some fundamental factors, such as tariffs and some of the immigration things that might cut the other way. And this is why it kind of is in the question you asked before, the soft data, the hard data, which one's going to be right. I think they're both going to be right in different ways. But it is a very uncertain environment. I mean, I used to do these counts on how often we say uncertainty. It kind of got out of control, right? And so I tried to tone it down, but then you realize, you talk to business people, you talk to Wall Street or financial market participants. I mean, the uncertainty, there's clarity on some things. The fiscal policy, I think, is more clear, but there's still just a lot of uncertainty about how things are happening. So markets seeing this I think in a positive way in some aspects, but I think they're kind of cross currents.
Thanks for your talk. In 1933, Congress prohibited interest on checking accounts kind of to prevent competition between banks and jack up their profits, and that was finally ended for now accounts in 1980, and Dodd-Frank actually ended it on demand deposits in 2011. And for a long time, rates were zero, so they weren't going to pay anything anyway. But now rates have been over 4% for over 2 years now. And it's hard to find a commercial bank that offers any interest on checking accounts. It's not quite true. My bank offers 1 basis point, which is pretty much an insult. There are savings banks that offer over 3%. Why are the commercial banks not offering any interest, not competing for interest? Do the regulators prevent them from competing, or are they colluding, or are they just lazy?
Do I get another choice? Obviously this is decisions made by banks about what interest rates they're offering on different products. And as you point out, checking accounts, there's savings accounts, there's CDs, there's other products that they offer. So, I mean, without opining on the decisions that banks are making, you clearly can get higher interest rates if you go into different products. And there's clearly competitive pressure during, during the since we started hiking rates, and as interest rates went up, you saw deposit betas. That's a measure of the average deposit rates. The banks were kind of being forced to pay interest rates on deposits across their portfolio of the deposits they had went up in a way that was very consistent with what we've seen in previous monetary cycles. So I think that the average interest rates have moved up that the banks are offering. But as you pointed out, that could mean zero interest rates on certain products. A lot of accounts don't pay interest, but a lot of other accounts are paying something close to a money market interest rate because the competitor is, of course, a money market mutual fund or T-bill or something like that. So I hear what you're saying about certain types of products don't offer interest or offer a basis point, but other products that banks are offering to their customers, we've definitely seen the interest rates on those move up in a way that, at least economists that have studied this show is I think reasonably consistent with what we've seen in the past.
So you alluded to it earlier, but is there at least a range that you're thinking about in terms of the run rate for payroll growth on a monthly basis to keep the unemployment rate relatively stable? And then maybe as a follow-on, how are you thinking about that significant reversal in immigration flows as more of an upside inflation risk versus a downside growth risk and balancing the two?
So at the beginning of my comments, I said I was really looking forward to our discussion and the questions, and this is proving this is completely right. That was a great forecast. These are all the right questions, but they're the things we do, and you do in your regular day work jobs. So on the run rate, I guess I feel very uncertain about that. I mean, and I feel like if I say a number, then that becomes a number, and I don't feel that confident in that. And I feel like there's a range of views on this. I guess my lesson from the last few years was this is kind of like a pure signal extraction problem. I've got multiple indicators. I've learned that one of my indicators has a lower signal noise ratio or higher noise to it. And so I just say, of course, I guess I should come up with my best estimate, which is what you're asking. But then at the end of the day, I'm just downplaying that. Now, obviously, if you saw a major swing, I mean, we know what payroll numbers do around turning points and things. So that's a different question than you're asking. So I think with the payroll, I should have said this. With the payroll numbers, I think there's two things that people look at. They look at the break-even question. Is it 100,000, is 100x, whatever, or below? They ask that, which is kind of this fine-tuning, kind of what's the thing that keeps the unemployment rate constant? And that's the one I'm kind of nervous about. Then there's things, is the economy, hitting a turning point? And that I don't think has to do with the break-even. That has to do with a more abrupt switch. And so again, I think these are important numbers. You had a second question. I just don't have a view on the break-even.
The outside inflation risk.
Yeah, so that's a really tough one. And so, one way you can think about it is during the higher immigration. And people said, and I think I said publicly, you got more labor supply. That puts downward, pressure maybe on wage growth in sectors where this labor supply is coming in. That's just like Econ 101, right? So especially in construction and agriculture and some areas that we're facing very severe labor shortages in hospitality, I should have said. With severe labor shortages, that labor supply coming in alleviated that, and maybe this nonlinear Phillips curve thing, we're moving down that. So I could see that. Of course, the labor supply also brought demand for goods and services. People who came into this country or working, joining our country were also buying things and needed homes and stuff. And so the net question, does an increase in labor supply is that a net increase on kind of inflation or not? Depends on the weight of it's almost like a marginal propensity to consume kind of argument. And I think the answer to that is the first order effects is these are basically balancing. In certain industries, I think they kind of work to reduce the supply shortages. And in maybe some areas, like in some areas, I know in Canada, we heard a lot about housing costs related to their huge wave of immigration. So I think at the granular level, you saw some relative price shifts, And the aggregate level, I would say it's at least a first order approximation, kind of a supply equals demand. I'm not doing Say's law here, but roughly. One more?
Hi, Prajakta Bhide, US economist at NYABE Partners. I had a question for you about how restrictive do you think monetary policy is, and informing that view, how much weight do you put on the long-run estimate of R star versus the cues that you may be accumulating from the performance of the economy?
Yeah, so I think in my view, and of course let's double underline the thing, I'm speaking for myself and not necessarily anyone else. I view the kind of the notion, like I said in my speech, I said modestly restrictive is what I said. I view that as really a statement of how is the economy performing given the stance, given the where real rates are, right? So the modestly restrictive I see is saying, with this stance of policy, in the absence of new shocks or anything, I would expect the labor market to weaken modestly relative to kind of where it is. So I have the unemployment rate kind of going up a bit, but only from where it is today to something like 4.5%. And I would expect inflation, underlying inflation, to continue to come down. So it's not an R minus R star concept in how I'm using it for the short, kind of in the near term. In the longer term, well, I do think there's a neutral real rate out there somewhere. It's hard to pin down, it's uncertain, but in the longer term, I do think, once the economy we get inflation back to 2%, which we will, and once the economy is back to its glide path, I think we will have lower real rates than we have today, because real interest rates are quite a bit above kind of most estimates of R star.
All right, so before we close, I have a couple more questions for myself. And normally, when we have a speaker at NYABE, I try to find something I have in common with the speaker in terms of my career, and with you I have two things in common. So the first thing is we both started our career in a pizza joint. You, I believe, were managing it, and
I was a general manager.
I was delivering pizza, and it wasn't the same joint. And then we later both went to LSE to study economics, and it wasn't at the same time either. So I have two questions. One is from New Yorker to a New Yorker, and the other one is from economist to economist. Okay. So where do you go for your favorite slice of pizza in New York City? That's the first question. And the second question is, do you have a few words of career advice for the economists here in the audience? Myself included. Yeah. So I represent the entire 2nd District of the Federal Reserve here, and I've learned one thing from my first day at the New York Fed. People have extraordinarily strong views on pizza. And people gave me a lot of wonderful advice about pizza, bagels, and everything else, and how to pronounce the names of the streets and everything. So that was a fantastic introduction to New York Fed and to New York. One thing I also learned is that when I expressed my own personal views on pizza, and perhaps somewhat conflicting views on pizza, that didn't end well. So here's what I'm going to do. So I love pizza. I did run Blondie's Pizza in Berkeley way back in the day for a number of years. It is where I met my wife. We've been married 35 years, so pizza, that's the best. But I also learned that pizza is not one good. So if you think about the BLS categorizing things, it's not pizza. There's deep dish, there's thin crust, there's that stuff they sell for $2 on the street corners. There's all these wonderful things, and I love them all in their own ways. So I don't have a favorite pizza. I will say I have a pizza I'm very proud of, and I'm going to brag here a little bit, because going back to my pizza days, my wife and I both did pizza, and she's basically told me, we will never do pizza again. I mean, we did our pizza, we're not going back. It's like, Catherine, wouldn't it be great to open a pizzeria in retirement? No. So, but she did give me a pizza oven during COVID so that we could have pizza together. And I've been making I'm very proud of my New York pizza, all New York ingredients, flour, or 2nd District ingredients, whoa, got careful here. Flour, sauce, salami, pepperoni, meats from local farms, cheese from local farms, vegetables, everything. So my favorite pizza is all the pizzas, but I especially like making the homemade pizza. It's one of the most fun things to do.
Okay, so as career advice, you know, I honestly feel, I just met with the interns of the New York Fed today, or a group of them, or meeting with the rest of them, you know, and it's just amazing to meet with young people who are just starting, say, in economics or thinking about this. Because I think economics opens so many doors. It's like, it's a way to, it's kind of a philosophy of thinking about things. You think about not only supply and demand, but you think about opportunity, cost, marginal kind of analysis. You think rationally about a lot of things. So I always think that my advice is really to think about what are the, you know, kind of broaden your perspectives. What are the various things you can do? I love public policy related kind of work. I know a lot of people work in the private sector, a lot of people work in education. I think the advice I got in studying economics early on is find the thing, you know, if you're a student, find the thing that you really care about. And the thing that you really excites you. I got asked by a student, why do I kind of like, you know, what excites me in the morning? And, you know, I can list 40 things about, you know, my job that do that. But it's like, what is it that you find you're passionate about? And focus on that. And that could be any of these things. It could be, you know, focusing on understanding, you know, financial markets. It could be working in, you know, a company. It could be teaching. It could be, I would say, argue it's like amazing at the Fed because we get to do research and apply that to the real world problems. So my advice is always to kind of find the thing that you really love to do, the thing that, you know, I always ask people I interview. So if you ever interview the New York Fed with me, here's the question I ask you. Your alarm goes off in the morning and you think about the day ahead at work. And what's the day look like? When you jump out of bed, you race over, you get the coffee and you go to work. What's that day? And what's that like? What are you doing? And then I ask, what's the one that pushes the snooze button 3 times? But the thing on the first question is, I think that's the one. It's like, what are you passionate about? What do you love doing? You're going to work your tail off. You're going to keep working on and figuring things out. And finally, just ask new questions. Think about new issues. I mean, one of the things that's amazing about the Fed is we have more questions that come up every week than we could possibly answer. And, you know, people ask me, how do I keep doing research even though I've got all these other job responsibilities? It's because there's so many things we don't know, things we want to understand, and I have no work-life balance. So that's my answer.
So John, thank you very much for your very thoughtful remarks and for the conversation. And thank you all for participating and enriching the conversation. With that, let's conclude the program. Have a wonderful summer, and we'll see you in the fall.
Thank you.